Our focus on hot picks today is big, really big tech stocks. Our guest is Amazon.com as his top idea. He cites stable growth in retail and advertising, among other factors. We're joined by Scott Devitt, Managing Director in Equity Research at Wedbush. Scott, great to see you. Amazon's been a disappointment, though, this year, up only around 1%. First off, why do you think investors have been cool on the name?
Good morning, Andrew. It's been, even more than this year that Amazon's kind of underperformed the Mag 7 overall. And I think part of it is beginning with an elevated multiple. A part of it is at the emergence of this AI boom. Amazon's AWS business has been viewed as a laggard. And that's what we think is going to change as we exit 2025 and into 2026. As you noted, the retail and advertising business is quite healthy. Investors are very focused on AWS and whether that business can accelerate, back into the sphere of what some of its peers are growing. And we anticipate that AWS can accelerate back into the 20+% range, starting with the fourth quarter of this year.
Why has AWS been growing more slowly than investors hoped?
Well, Amazon probably hasn't moved as quickly as others in terms of deploying capital to serve customers with these new AI chips and particularly NVIDIA chips. And so you've had the emergence of new platforms like Oracle and CoreWeave, as well as Microsoft investing aggressively. But Amazon's very methodical about this, and they're in the process of, at the end of this year, launching a very significant data center cluster called Project Rainier, which is really levered to its relationship with Anthropic. Anthropic's a business that started 2025 at about a $1 billion annualized run rate and is going to exit at around 10. It's about 40 cents of every dollar that Anthropic generates in revenue flows through to AWS. And so that alone will be 200 basis points of acceleration in 2026 for AWS. And so we think that's, at the core of being the catalyst. And it also, explains a bit, it's taken some time for Amazon to get to this point for why it's been a laggard up till now.
And what about the retail business generally? I mean, pretty tough competition from the Chinese platforms, notably Temu.
Yeah, I think that the Temu threat has been overstated, in my opinion. I mean, I think Amazon's retail business and its advertising business are as well positioned as they've ever been. Consumers like quality, convenience. Consumers like fast shipping. In general. And I think certainly prime customers like that. And so you see that in Amazon's results. I think their retail business is dominant as ever. I think, something that is not out of the realm of possibility, probably not something that Amazon would suggest they're considering. But, separating AWS from retail and advertising is something at this point in time that I think is not a crazy idea any longer and would identify the individual values of the franchises. The advertising business alone is going to do $70 billion of very high margin revenue this year.
Your next idea is Meta. That stock up about 23% so far this year, but you do see upside.
We do. Meta in 26 is going to go through a period where it's likely to, for the first time in a number of years, grow operating profits more slowly than revenue. So, it's going through a little bit of a digestive phase, I think, in anticipation of that right now. But what's so powerful about Meta is they're probably the most front-footed consumer company right now in terms of incorporating AI capabilities into its platform, both from a consumer-facing standpoint with things like the new glasses that were announced a couple of weeks ago, as well as through the organization in terms of providing tools to employees as well. So I think you're going to see labor efficiencies offsetting some of that margin deleverage and the beginnings of real contribution from AI infusion into that business model. So we like it quite a bit. It's been a good year. I think there's a little bit more digestion of this perception of the deleveraging in 2026, but we still like that stock quite a lot.
I got to admit, Instagram, I've fallen into a black hole with that this week. It's pretty darn addictive. That algorithm knows what it's doing.
It sure does.
And finally, Google. That stock doing well this year, actually outpacing Meta. I was interested to see.
Still a material underperformer relative to Meta over an extended period of time, but it has outperformed this year. the greatest opportunity in Alphabet, from a short-term standpoint has passed, as the company had been bucketed as an AI loser for a period of time. The stock was in the 160s, and it's kind of reversed all of that now and trades at a more reasonable multiple. The multiple of Alphabet now is back to being in line with Meta. So we're kind of indifferent between the two. I think for a period of time, Google's deficiencies relating to search and the AI risk were being overstated, and that created a huge opportunity in the stock. And I think of both these companies, both Meta and Alphabet, as more kind of 12 to 15% compounders from here. Whereas with Amazon, I think to the extent that it plays out the way that I described, you could have like a 30% year ahead.
That's amazing. Just the level of innovation and spending at these companies. Scott, always great to hear from you. Thank you very much.
Thank you so much.
Scott Devitt, a managing director, equity research at Wedbush.